Welcome back to the Wall Street Podcast. Today, we're cutting straight to the Federal Reserve's latest monetary policy. We're drawing directly from today's Wall Street Journal. That's September 18th, 2025. Our mission, really, is to unpack the Fed's recent rate cut and its, broader economic outlook. We want to distill what it truly means for you. Let's get right into it.
Okay, so the Federal Reserve has indeed cut its benchmark interest rate. It's down a quarter point. They're now targeting a range of 4 to 4.25%. And the really compelling detail here is that officials have already penciled in, well, at least 2 additional cuts for this year.
2 more. So that implies moves pretty soon, maybe October and December.
That's the implication, yes.
Yeah.
Consecutive moves seem likely based on their projections.
But hold on a second. Isn't it a bit, counterintuitive to cut rates when inflation is still ticking up? That specific detail, it just seems to contradict the usual Fed playbook, doesn't it?
It does seem that way on the surface.
So what's the real thinking there? Especially with Chairman Powell calling it a risk management cut. He pointed to a weakening job market, right? Payroll gains averaging just 29,000 over the last 3 months to August.
Exactly. And unemployment ticking up to 4.3%. So this decision comes even though core inflation actually ticked up to 2.9% in July. That's quite a jump from April. And the SAR's own forecast doesn't see them hitting their 2% inflation target until, get this, 2028.
2028.
Wow. Yeah, so this move, it signals more than just, a bit of tolerance. It suggests a potential shift in how the Fed reacts.
Like a new normal, maybe.
Possibly, where employment stability gets prioritized, even if it means inflation stays above target for a while. For investors, well, this might mean you need to reevaluate how you price risk in longer-dated assets. The goalposts could actually be moving.
And not everyone agreed internally.
No. Fed Governor Stephen Miron dissented. He actually wanted a bigger cut, half-point cut.
So, okay, first big question then. What does this signal for markets? The Fed clearly prioritizing job market concerns over this persistent inflation.
Well, it strongly suggests an increased tolerance for inflation to safeguard employment. That's the main takeaway. Markets should probably anticipate sustained inflationary pressures coexisting with a pretty fragile job market.
And that hits asset valuations.
It certainly impacts asset valuations, yes. And if you look globally, you see similar thinking. Canada also just cut rates.
Oh, really?
Yeah, and they specifically cited U.S. trade policy as a factor impacting their own economic outlook. So there's an interconnectedness there.
It really sounds like we're talking about 2 different economies almost. High earners versus low earners. The journal outlines this divergence pretty starkly. How does that split actually play out across different industries?
It's a really significant split. High earners, their spending is still robust. That's helping luxury sectors, high-end travel, premium goods. They're doing okay. But on the other side, low-income consumers, well, they're facing slowed wage growth, high housing costs.
Housing costs are still a major issue.
Definitely. U.S. housing starts were down 6% in August alone. So these consumers are really curbing their spending. You see the pressure on companies like, say, General Mills. They reported nearly a 7% drop in sales.
Wow, that's significant for a staple company.
It is. And it even affects market debuts. Look at StubHub's IPO. Pretty volatile. Closed down over 6% on its first day. That signals nervousness about consumer spending.
Okay, let's shift gears a bit. Portfolio strategy. We've got inflation sticking around, rising national debt, maybe a shifting picture for the dollar. What's the role for gold here as a hedge?
Gold becomes quite relevant in this environment. It serves as a hedge against what's called fiscal dominance.
Fiscal dominance, meaning?
Meaning when government debt gets so high that monetary policy starts being influenced more by the need to finance that debt rather than just inflation targets. Gold also hedges against, a potentially diminishing appeal of the dollar. And we're seeing central banks buying gold, which supports this trend.
So it's like portfolio insurance.
Exactly. A strategic allocation, maybe somewhere between, say, 0.5% up to 9%, depending on your risk tolerance, can provide some robust insurance against these bigger macro forces.
It's easy to talk about these big trends, Fed policy, market moves, but these aren't just numbers on a screen. They really shape daily life for everyday Americans.
Absolutely. I mean, think about housing affordability. It's getting worse for many. Or job security, especially for young college graduates. Their unemployment rate is up at 6.5%. And you have AI-driven displacement becoming a real factor now, too.
So the landscape is genuinely challenging for many.
It is. And these pressures on lower income groups, they don't just show up in sales figures. They can ripple out. For instance, the journal piece noted a resurgence of cheaper, purer cocaine, possibly linked to shifts in drug enforcement focus.
That's a grim connection.
It is, but it highlights how economic stress can have these broader societal impacts on public health spending, the labor force, local economies. It's all part of this complex web.
So as you, the listener, weigh these interconnected dynamics, the Fed Balancing Act, the divergence in the economy, the daily costs impacting your household, maybe the question to consider is, are we actually on the cusp of a fundamentally new economic reality?
Understanding how all these pieces fit together from monetary policy down to, well, your daily costs, it's really crucial for navigating what comes next, both for your finances and your broader outlook.